Wait.
live from the International McNeil Film Studios. Here's our fabulous professor, Professor McNeil.
Thank you, Scrub. Thank you. Today we're going to talk.
Hey, are you guys?
Go sit. Go sit down. Go on. Today we're going to talk about the money markets, the bond markets, and its effect on aggregate supply and aggregate demand. So, here are the bond markets. Bonds are basically ways that companies or government agencies borrow money from people. So, there's the demand for these bonds, there's the supply of these bonds, and a price comes out of the bond, say $950. This is the price of the bond. This is the quantity of bonds sold per trading period in our market. There's the quantity, Q1. Now, this $950 we assume is for a bond that becomes $1,000 at the end of 1 year. So, you earn $50 on $950, which is what you paid for this bond, times 100 to make it a percent, and this will give you the percent bond yield on this. All right, so these are the bond markets. The money markets, there's money supply. We assume that, let's see, there's money supply. It's a relationship between the quantity of money and the nominal interest rates. So, money supply is determined by the Fed. The Fed decides, it's assumed, that they want Q1 dollars out there and they put them out there. That's it, regardless of what the interest rate is. But money demand, there's money demand. Money demand is the relationship between quantity and interest rate. It's assumed that nominal interest is the cost of holding money because it has two parts. The first part is okay. Real interest, and the second part is
Fake interest.
expected inflation.
That too.
Now, the demand for money means that people want to do what with money? It's the demand to do what with money? The demand to?
Trade, spend,
No,
post
again,
it on a...
thanks a lot.
Okay,
Thanks.
okay.
Frederick? The demand to?
To hold money.
That's right, to hold money.
That was
To
my next.
have and to hold.
That was my next guess.
And if the interest rate is high, that means the cost of holding money is very high because when you hold money, you don't get interest. You don't earn anything on it. If the cost of holding money is very low, people are content to hold lots of it. So the relationship between the amount of money that people want to hold and the nominal interest, which is the cost of holding money, that's money demand. And out of this comes an interest rate. This is nominal interest rates for the economy coming out of the money markets. Now, the last we're throwing in here is our friend short-run aggregate supply and aggregate demand. Here's real GDP, and here is the price level. So this tells us at this price level, P1, the real GDP is going to be Q1. All right, so this gives lots of opportunities for any kind of change to occur. What if the Federal Reserve increases the money supply to MS2? Well, turns out that I1 here is no longer an equilibrium. At I1, this is the quantity of money supplied, but this here is the quantity demanded. Now that the Federal Reserve has put more money out there, we have to remember that the amount that people are actually holding is the money supply, that's this one, and the amount that people want to hold comes from money demand. So in this case, there is a quantity supplied greater than quantity demanded. There is a surplus of money. And how do people get rid of their money in a two-asset world, money or bonds? They
Go
get
to
rid of their money
Vegas.
by buying bonds. So we go over here to the bond market, and buying, of course, affects demand. So the demand for bonds increases. That causes the price of these bonds to go up to, we'll say, $9.70. And if you calculate the return, when you're paying $9.70 for a bond that's going to be $1,000 in a year, that yield is $30 on a base of $9.70 times 100, of course. And this yields an interest rate that is lower, 3-point-something%, as opposed to 5-point-something%. As interest rates go down, people are content to hold more money. And the interest rates will continue to go down until we get a new equilibrium in the money markets at a lower interest rate. Now, when the interest rates go down, we move over here to aggregate demand, and you'll recall that aggregate demand has 4 components in it: consumption, investment, government, and net exports. And when interest rates go down, consumption goes up, investment goes up, and net exports goes up. And this causes aggregate demand to shift to the right. This causes real GDP to rise and will put upward pressure on the price level as well. So this is the relationship between the money markets, the bond markets, and the real GDP. There's one other bit, and that is that it's not just people in here buying bonds, but how did the Federal Reserve increase the money supply in the first place? They have 3 tools: reserve requirement, discount rate, and open market operations. And when the Federal Reserve wants to increase the money supply, they buy bonds in the open market. In this case, U.S. government securities they buy. And by doing that, they pull bonds out of the economy and put new reserves into it. So the Fed's in the bond markets buying, and then in response to the increase in the money supply, people are in the bond markets buying. Bond demand goes up, price of bonds goes up, interest rates go down, and that causes consumption, investment, and net exports to increase. Aggregate demand shifts to the right. Thank you very much. Out.
Sayonara!